kind of resting today. But I mean, wow, Bill. I mean, what's going on here in the Japanese debt market? What are some of the greater ramifications and implications?
Well, what that shows is that the Japanese bonds are being sold. That chart is of interest rates, not the price of the bond. If you put a chart up of the price of the bond, you'd see that the bond market is collapsing. And why this is important is because the yen carry trade is what funded for years and years and years a lot of the capital going into stocks, bonds, even real estate across the world. I mean, it was basically the piggy bank to borrow from because interest rates were non-existent. I think the 30-year was like a half a point or below a half a point. The yen was a stronger currency than it is now. And what you have is those that borrowed in yen. Now that interest rate has gone up and the yen itself has gone down. So it's a double whammy on those that borrowed. It makes it harder to carry because the interest rates are higher, and it makes it harder to pay back because you're using yen to buy dollars to pay back. So it's the carry trade blowing up, and understand that the world is 100% financialized. Everything has been financialized, and this was one of the early uh, credit markets that funded the bubbles, basically.
Yeah, here's a chart of the yen. I don't know if you can see it, but the yen
Right,
right now is at almost the lows we haven't seen since the 1990s, essentially.
correct,
Looks like it's kind of
exactly.
yeah. I mean, it's sitting right on support. If it breaks the support line, I mean, it's pretty much not blue sky territory, I guess. Go 6 feet under or whatever analogy you want to use,
Right.
but yeah, I mean, why is Japan so significant? This
Well, it's significant because this was the mechanism that they used to create capital, to borrow uh, capital to put into other markets. And
mhm.
now you've got interest rates going through the roof. You've got the yen cratering. And what does Japan have that they're able to sell to try to slow this or stop this or whatever? The only thing they have, or the biggest thing they have, are US treasuries.
Mm.
And they own what, 7 trillion of US, I'm sorry, the Japanese bond market is 7 trillion. Japan owns a trillion thereabouts of U.S. Treasuries, and they're gonna start selling those, and that's going to put more upward pressure on our yields. And if you go back a couple of years ago when the Fed went through their first easing cycle, uh, they eased, but market rates actually went up anywhere from 3/4% to a full percent. Now we're in another easing pattern, and the question is, what happens to Treasury yields? Do they go down or do they go up? And if they go up, then what you're looking at is the central bank, the Federal Reserve, is losing control of the yield curve.
Yeah, it gapped up higher yesterday as well. This was a common theme across the bond markets.
Right.
So we're currently trading at 4.28 on the 10-year yield and 4.91 on the 30-year yield. And it's like you said, in 2024, if we go back down here, you'll notice a big uptick. This was around when Powell started cutting rates, and
Right.
it had the opposite effect on the 10-year yield. It
Exactly.
actually spiked up. So what is it? What would it portend if we see the same phenomena arise again once they start cutting rates heading into the rest of the year here?
Well, if that happens, it's complete disaster for the central banks because it means their policy no longer works. And if their policy no longer works, uh, there's so much debt outstanding. I mean, you have basically orphaned credit markets that are going to trade truly without without being massaged or steered by the central banks. I've said all along, Danny, that the end would be a credit event. And that's what you're watching right now is a credit event. And I don't know if you have a chart or can do a chart, but if you overlay the bond yields in Japan with gold, they're in lockstep.
Yep.
And it makes sense. Yeah, there you go. It makes sense that gold and Japanese yields are in lockstep because what what gold is sniffing out is a credit problem. Now, most people think that you buy gold to protect against inflation, but you also buy gold to protect against, more importantly, you buy gold to protect against default. Uh, and that's what this market is sniffing out is that there are serious fiscal problems in Japan. And there's serious fiscal problems all over the world. And you'll see that you'll see gold uh, going up along with bond markets around the world going down and currencies around the world going down.
Yeah, I don't know
And
if you can
then,
see it, but there's like a 2 to 3 month lag between the gold price spiking up
right,
and then the bonds following suit. So it's like you said, it's
right.
sniffing out the move. Sorry, what were you going to say, Bill? I cut you off.
Um, I lost some thought.
Okay. Well,
It'll come back to me.
gotcha. Well, it seems like now we're in the midst of Davos World Economic Forum. There was a clip going around yesterday of Ray Dalio pretty much saying what we're talking about today. I don't know if you saw it, but he pretty much said that the
Yeah,
existing monetary system is over, and that's why you're starting to see
right.
flight into gold and silver and monetary metals. And yesterday,
Okay,
something else also happened. I don't know. You may have caught it too. But the market sold off pretty
right.
drastically. But gold, silver, platinum, oil, natural gas, and even the equities in all of those respective metals and commodities, they all spiked higher. So it's as if there was a decoupling. It's as if we're witnessing a decoupling
Right, we
of,
are.
yep, of metals, energy, metals and energy stocks away from the broad stock market.
Yeah, and just to refresh people's memories, an ounce of gold is an ounce of gold. 100 years ago and 100 years from now, it does nothing. It doesn't go up, it doesn't go down. It just is. What changes are the currencies. And I've had people ask me, we've had such a big run in gold, such a big run in a bigger run in silver. Should we be selling? I'm going to tell you, or I'm going to ask you, if you sell, where do you put the money? What currency do you hold the money in? Where is where is anywhere in the world a credible currency that you can confidently hold that capital? The problem is there is no credible currency in the world today. So that's what's happening is currencies are collapsing. The fiat system is failing. The experiment, what is it, 80-year experiment since 1944, Bretton Woods, and then again from 1971, that fiat experiment has failed. And people are seeing the failure and they're getting their capital out of currencies and into real money, gold and silver. I mean, why are central banks buying gold? Basically because they don't trust the large balances they have in dollars. They're worried about a gigantic black hole of nothingness where they had dollar holdings. So that's why they're buying gold is to plug up the holes that are going to be created by fiats. And just a perfect example, and I think I read the number this morning. Russia's admitted, and when I say admitted, I believe they have much more than what they're saying.
Mhm.
But Russia's admitted gold reserves have risen $260 billion since the United States stole their $300 billion. So that's an example right there of a central bank
Interesting.
holding gold that makes up for the losses in fiat currencies held or treasuries credits that are held.
Is there anything you would trade into? So I I get the perspective that you wouldn't want to trade in your precious metals for fiat currency. That's currently we're witnessing devalue in real time. But would you trade it? Would you trade gold into platinum? Is there any other? Are there any other sectors within metals or in commodities that you see as better value right now for someone that is looking to allocate capital into?
Yeah, platinum and palladium are more industrial than anything else. And if you get a major hiccup in the auto industry, a lot of that demand is going to go away.
Hmm.
So, I mean, I would stick with silver and gold. They are more money. I mean, gold is pure money, but silver is more money, has a monetary history compared to palladium and platinum. Um, there are no currencies anywhere on the planet to put your quote your winnings if you were to sell gold or sell silver. So, okay, let's look at other assets. The only other asset that I can think of would be if you live in a city, you're not going to survive when this thing goes down. You've got to be outside of a city. You've got to be rural. So if you've got big winnings in gold and silver, take some of those winnings and relocate yourself and get the hell out of Dodge.
And that sounds priceless because we're looking at this winter storm that's coming down the pike here across the eastern seaboard of the United States, as well as the south and the southeast. And I'm seeing forecasts that there might be power outages for over a week. And so, uh, yeah. I mean, you've talked about it numerous times. Like once the lights go out or once the services go down, it's going to get
Society
really
will break
brutal.
down.
It's really going to
Society will break down.
it'll break down to its very fundamental core. And
Exactly.
you've tied this into the scenario of a failure to deliver, which I think we've flirted with now, like a number of times
Yes.
within the last several months. Like it's gotten very close, especially with silver. What's the current status on that, the way you see it?
Uh, the current month of January is not a delivery month. And I think we're at 35 or 40 million ounces standing for delivery. That is the largest January delivery ever. Normally it's, a million, 2 million, 600,000. It's like nothing. Historically, no deliveries get done in January. So for 30, 40 million ounces to be delivered in January, that's outstanding. I mean, it's an outlier. A big delivery month is March. So March 1st, we get first notice day and we'll find out what starts to stand. But what's happened over the last 2 or 3 years is that you start with, let's use the number of 100. You start with 100 contracts standing for delivery the first day of the month. And by the end of the month, you might be up to 200, 300 or more contracts standing for delivery. It used to be the other way around. You start with 100 and you end with 7. Now we're starting with 100 and ending up with 200 and 300. So what we're witnessing is contracts are being bought during the month with the express intent of taking delivery. And March, the month of March, that delivery month, very well could be the failure to deliver because there's only 120 million ounces available to deliver.
And that's on the silver front. Do you see any danger on the gold side?
No, gold is not as tight as far as the deliveries versus the available inventory. But I mean, it's the same thing. You've got constant demand from central banks. I forget which central bank overnight announced they're going to buy another 150 tons this year. I mean, it used to be, if you go back to the year 2000, it used to be people would wait for announcements from central banks telling us how much gold they were going to sell. And of course, it pretty much ended in 1999 with Gordon Brown. They called it the Brown Bottom, where they sold what 60% of Britain's gold at well, I think the number was $280 an ounce or something like that. So it used to be that central banks were sellers, but now they're buyers. They're buyers all over the world. Western central banks, the Eastern, all the BRIC central banks, they're all buyers. So the demand is there because uh, central banks are fearful of a credit default because gold is the only monetary asset that they hold that cannot default.
And then another one is copper. Copper's,
Yeah, but
silver
that's
is very,
industrial. That's purely industrial. There's no monetary aspect to that whatsoever. And actually, let me tell you a story. If you go back to 1928, 1929, Newmont was a mining company, and uh, they had they were a bigger copper miner than they were gold. And what they did was they switched their focus to gold. Then 1929 came, the depression came, the demand for copper dropped, copper collapsed, but the demand for good money exploded. So they made tons of money because their product, gold, they were selling it at much at higher, from $20 to $35. So they had a 70% increase in what they were selling. And because we were living in a deflationary environment, their cost to produce it had gone down. So you had uh, Newmont survived because they turned toward gold and away from copper. And you don't want copper in an economic downturn or especially in depression.
what about the deficits in copper? Copper is also an industrial metal in
Correct.
the same fashion that silver is too.
Yeah, correct.
Yeah.
But what deficits will there be if the real economy is shut down? There will be surpluses.
You think it'll come down to that? Once we see a failure to deliver, they'll just shut down the economy?
Well, it'll shut down the financial markets and the financial market, and that is that includes the credit markets. The real economy cannot run in any fashion without credit. There's credit used in
Hmm.
every single transaction you touch, see, come across on a daily basis. Credit is everywhere. You just don't see it.
Yeah. Yeah, and it seems like all of these metals are starting to perk up. It's not just silver and gold. I mean, we mentioned copper. You can look at lithium. You
Because
can
they're
look at
real.
nickel. Yeah.
That's why they're real. I mean, it's
Yep.
something tangible that in a credit default don't go to zero because they still exist,
Yeah. We saw what they did with nickel a couple years back when the
right?
nickel price spiked. But
Yeah.
if all of these metals spike at the same time, can they keep the lid on this thing without, I mean,
No,
what are they going to do?
no, if everything spikes and everything is spiking at the same time, it's a if you want to call it, it's an admission, it's a market admission of failure.
And this would have ramifications downstream to
Oh, of course.
credit, like you've said before.
Yeah.
Um, just from a failure to deliver in the silver market, that's astounding. Like the silver market is relatively small. You've got
It's
a
very
four
small.
plus trillion dollar
Yes.
market cap. The grand scheme of things, that's like the Nvidia market cap to an extent. So to see the ramifications of something like that just be so widespread, I think people just take it for granted. And I look out, in my everyday life, and still, like retail, still hasn't sniffed out the silver trade
No,
as much as you would think, if at all.
not in North America. You're viewing it in North America. Worldwide, it's crazy. I mean, you've got dealers with lines going on the block to buy stuff.
Hmm.
In North America, you have people that bought, and junk silver is an example. You got people that bought in the 70s and 80s, and that was really the only way to buy. And they sat on it for years, and now they're finally above water. And you've got big sellers. North America has not caught on fire yet. Now, I'm surprised it's not, but it has not caught on fire.
So I want to show you this chart here, Bill. I think you'll find this fascinating. This is a chart of the 10-year yield and with gold overlaid on top of it. And what you'll notice.
All right, quick break here because if you're buying gold or silver the normal way, you're probably overpaying by a lot. And that's because most retail dealers quietly tack on these huge markups, sometimes 10%, sometimes 20%, sometimes even 30%. And you don't even notice it. It's like paying $115 for a $100 bill. Doesn't make sense, right? So that's why I've been using the Bullion Standard Pro. It's a membership that basically lets you buy precious metals at real wholesale prices. The same prices that dealers get. So no inflated premiums, no middleman games. Their platform updates every 5 seconds, straight from mints and distributors. So what you see is literally the real market. And here's the crazy part. If you buy something like this gold American Eagle, here's the amount of money you're going to be saving at the time of this recording, at least. So it basically pays for itself multiple folds on many occasions, depending on what you buy. And if you want to try it out, they're hooking up my viewers with an exclusive 10% off their first month. Just use promo code COSM10 at checkout. That's COSM 10 at checkout. So if you're stacking, investing, or just tired of getting hit with hidden markups, check them out now. Bullion Standard Pro. Click on the link down below in the description box and use promo code COSM10. Now let's get back to the video.
Is whenever we have these these increasing interest rate environments, the price of gold just tends to follow it. Once that ended in the 80s down to the 2020s, gold pretty much went sideways. It did have a bit of an upswing here in the 2010s, but now that that's over, I think also silver might be a better example, actually. You look at silver, even better. Silver moved in tandem with interest rates from the 1940s to the 1980s. Once that started coming down, silver pretty much moved sideways for 4 decades. Once we broke this downtrend in interest rates, that's when silver began to get its bid.
Right. It's the end of a 40-year bull market.
Mm-hmm. And so it kind of begs the question, does this kind of imply that we're starting another leg up in this increasing interest rate environment? The last one took us 40 years. So it was 40 years up, 40 years down.
40 years down, exactly.
So are we looking at another 40 years in higher interest rates here with precious metals tracing that move?
Well, the answer is yes, if the system holds together. But this is systemic. There's too much debt. It can't be paid back. It's becoming harder and harder to service with the higher interest rates. The 40 years from now, the system is not going to look anything like it does today. The monetary system and the credit system.
Yeah, yeah. Well, it seems like they're trying to rewrite and reimagine the monetary system now, especially yeah.
They have to because it's a failed experiment. It doesn't work. You cannot, as a normal family, you can't spend more than you earn month after month after month. But that's what all these governments, especially the U.S. government, have done for years and years and years. We borrowed and we've spent more than we've actually earned. We've been forced to borrow to sustain our lifestyle, and that cannot go on. I mean, the family, their credit card gets shut off, their house gets repossessed, their car gets repossessed. In the case of governments, a typical end response is a war, because you've got other countries that own your debt that get pissed off that they don't get paid.
That seems to be where we're heading too.
Exactly.
It seems like they're just ending the fake rules-based order that's been pushed over the last 80 years.
Yeah, it's been a fraud, and the fraud is being exposed. And the ultimate exposure is when you have contract holders stand for the product and the product doesn't exist. Which is what happened back with the nickel. Nickel had been rehypothecated over and over and over again, and the nickel was not there to make delivery. Now, what they did was they wiped out a day and a half's worth of trading and said that didn't happen.
Yeah.
They can't, you could do that in a market. But you can't do that if it's spreading from market to market to market. And there was nobody out there saying, warning people, nickel's going to fail to deliver. Now you've got the monetary assets, gold and silver, and I believe it will be silver first. If those fail to deliver, then you got a real problem because those are money that compete versus the currencies that these central banks are able to freely print as much as they want anytime they want.
So what do you think they replaced the existing system with?
Well, the BRICS are telling you that they want to replace and no longer use the dollar. They want to use the unit, and that's going to be between 20 to 40% ratio backed, not convertible, but backed by gold, and then the rest with other commodities. They want free and fair trade, and they want real settlement. And if you're settling in a currency that does have backing of real assets, that's a real currency. There are no real currencies on the planet today. I do believe that the US will probably go, I think it'll definitely go into a central bank digital currency. And somehow, some way, they're going to say, well, we have this gold in Fort Knox that's going to back it. And, gold's whatever, pick the number, 25,000, 100,000, whatever the number is, to be able to ratio back the currency. The problem is, I don't believe that gold is there. And I think the world doesn't believe the gold is there either, because there's not been an audit since 1956. And I could envision China just hauling dump trucks into their national stadium and going along with a camera and saying, see, this is gold, this is gold, this is gold. Then they count the trucks and they say, we got 35,000 tons or whatever the number is. We showed you ours, you show us yours. It's going to be a moment of truth.
And what if we can't come up with the gold? What does that mean?
Well, the dollar is toast. It's completely collapsed. And then who's going to trade? Who's going to trade with the U.S.? I mean, if we're taking in a trade deficit of 500 billion or $1 trillion a year, who's going to send real goods for a currency that they know is shit? They're not going to do it. They'll just stop trading with the U.S.
And is that why you're starting to see the debt markets collapse here through these increasing interest rates? Is that investors starting to sniff out what's coming?
Yeah, that's one of the reasons. I mean, you don't have to be a rocket scientist. I typically will ask someone, and when I first talk to them, I'll ask them, do you think the U.S. government is broke? And 95% of the people will say, well, of course they are, but it doesn't matter. And the bottom line is it doesn't matter until it matters. And when it matters, it's completely game over.
Yeah.
So people understand that we have too much debt. It can't be serviced. I mean, hell, we're going to pay what, 1.5 trillion alone this year in interest? It's it's untenable. It's untenable math.
So if China is offloading its debt, U.S. debt, and Japan is too, then who's buying the treasuries?
Who's left?
The Fed.
There you go.
Are we heading towards yield curve control?
The lender and buyer of U.S. treasuries of last and only resort.
And so what does that mean when they start monetizing the debt? Is that are we just looking towards inflation at that point? Even more so inflation?
You just said the word, monetizing the debt. All you have to do is look at every attempt at monetization throughout all of history, and it ends with a currency that blows up, becomes worth nothing, and they got to start all over again.
So that's the end game. That's
this is not new territory. I mean, governments have monetized. I mean, you can go back 2,000 years. They didn't monetize, but what they did was they clipped the coins. They would clip edges off, or it wouldn't be pure silver or pure gold. It'd be 80%, and then 40, then 20. I mean, look at the Roman Empire. Where did the number end up at? 11% of what it originally was, something like that.
Yeah. Well, I guess we'll have to. I guess we've got no other means than to wait and find out. I guess. Well, you're also looking at oil still at $60. It's acting like it wants to move up higher,
What does
but
that tell you, though, Danny? What does $60 oil tell you?
uh, $60 sounds rather low. So it signals maybe a depression coming down, or
It signals the world that real economies are not strong
Mhm.
because the demand is not there for the oil that's being produced. And it's
But
not like, production is exploding. What's happened is the real economies have slowed and there's less demand for oil.
yeah, but I wonder for how long that stays to be the case because you look at all these other commodity bull markets. Um, this is looking to be like the biggest commodity bull market of all time. So it seems
Right.
kind of unlikely that oil doesn't eventually join the party.
But it's a monetary event
Mm.
is what you're looking at with the commodities. Commodities are looking at the purchasing power of the fiat currencies and they're watching it drop. Um, Oil, yes, you're going to have people that look at oil as a commodity, but it's used pretty much immediately. It's not stored, and it's used up. It burns up. So oil's a little bit different than say steel because steel you you buy steel today, you still have it a year from now or 5 years from
Mhm.
now. Um, the softs like wheat, things like that, those get used. But the biggest movers have been the call it gold, silver,
Yeah.
the real deal.
I want to get your thoughts as well before we wrap up on the mining stocks. Um, Gold mining stocks ripping it, totally crushing it. 2x multiple on the price of gold, pretty much on average between GDX and the physical price. You look at SIL, it looks like it's been keeping pretty much parity with silver. Do you anticipate 2026 being the year where we start seeing silver miners outperform silver?
I think you're going to see the entire mining sector, both gold and silver miners, are going to explode this year. I mean, there's still a bad taste in investors' mouths after 2011. We had the peak then, and I mean, literally, if you look at the price of mining shares versus gold from 2011 to I forget when it was, the 2021 or 22, something like that. The drop of mining shares versus the metal was about 89%. Now, isn't it an interesting comparison or coincidence that stocks overall in the United States dropped 89%
Hmm.
from top in 1929 to bottom in whatever it was, 1936 or 37, whatever it was. So the top to bottom was an 89% drop. And that's what you saw in the mining sector. The mining sector went through a depression. And the problem with that is mining is so capital intensive that it shut capital off to the miners. So very little exploration was done. You had good pieces of property. They couldn't get funding to mine. I mean, I'm involved with one that was saved. I mean, they could have run out of money, and now it's an operating mine, and it's going to be a great mine. But 2,500 plus miners went bankrupt, I think, from 2011 to 2018 or 19. 2,500 mining companies went bankrupt because they could not get funding. It's such a capital intensive business. So that's why it's important to understand that it went through a depression. And now, just finally now, you've got people willing to put money into the miners because the product itself has exploded in price. Their product that they dig up, mine, and sell.
Yeah. Well, Bill, it's been a pleasure having you on as always, my friend. Anything else you want to touch on before we take this thing home?
Uh, Yeah, let me just reiterate that I do believe, and I mean, you could see a $10, 15, $20 pullback in silver. You could see two, three, $400 pullback in gold. I don't care. This rally in the metals, I believe, is the rally you do not sell. And the reason you do not sell is because where are you going to put the money? Where's your alternative?
Yeah. Where are you going to
And
put
the
it in? Fiat
problem,
currency?
yeah, the problem with trying to trade is mathematically at some point we are going to go through a failure to deliver. And when we get to that point, and if you were being so cute as to trying to pick the top
Mhm.
and then trying to buy back in, there won't be any metal to buy. So don't be cute. This is the end game. It's the rally you don't sell.
Are you still buying gold and silver at these prices now?
Yes, absolutely. I mean, would you rather leave X amount of dollars in the bank, or
Mhm.
would you rather have X amount of dollars in silver or gold where you know that they cannot bankrupt? And I
Good
mean, we're
point.
not even talking about the great taking. Add the great taking in, and now you've got an institution that if they go down, you lose your money.
What do